Well, no surprise, the Fed raises interest rates by half a percentage point, 50 basis points, to a range between 75 and 100. They also outline the parameters of balance sheet reduction, which will begin next month, and promise more rate hikes to come. In their statement, the policymakers characterize inflation as elevated, reflecting supply and demand imbalances related to the pandemic, higher energy prices, and broader price pressures. Russia's invasion of Ukraine has unknown implications for the U.S. economy, they say, and related events are creating additional upward pressure on inflation, likely to weigh on economic activity. In addition, COVID-related lockdowns in China are likely to exacerbate supply chain disruptions. The committee is highly attentive to inflation risks. And so the decision to raise rates by a half percentage point for the first time since May of 2000, they say they anticipate that ongoing increases in the target range will be appropriate. They add the committee would be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goals. The decision unanimous this time. As for the balance sheet, the Fed says it will start letting Treasury and mortgage-backed securities roll off, mature, starting on June 1st. They will cap the amount that can roll off in any one month at $47.5 billion initially, 30 in Treasuries, 17.5 in mortgages. Those will increase over 3 months to 60 and 35 for a total of $95 billion. That's the figure that had been given in the minutes of the last meeting. Back to the language they used after stopping post-financial crisis QT. They say they intend to slow and then stop the decline in the size of the balance sheet when reserve balances are somewhat above the level it judges to be consistent with ample reserves. Guys?
McKee, let's whip through this price action. Equities with a little bit of a lift here, up 0.7% on the S&P, on the Nasdaq, up 6 or 0.7% also. A curious move in the bond market initially, had a bit of a rally, yields lower at the front end, started to price out just a little bit from the June meeting. McKee, then we come back again. 2-year yield unchanged at 2.78, still in and around the highs of the year. Has anything changed from what we've heard so far, Mike, that would lead you to change your question that you had prepared for Chairman Powell in 30 minutes?
I'm sorry, Joe, did you ask me?
I did, Mike. Is there anything new in this relative to what we expected coming into it all?
No, and the interesting thing is, I almost started off by saying you priced it in, they delivered. The Fed gave the market what it was expecting. And we were talking earlier on your show about how the Fed is sort of front-running itself. It's telling the markets what it wants them to do. And at this point, they seem satisfied with the markets adjusting to a regular rise of about 50 basis points. No suggestion in this statement of 75.
Michael McKee, we were talking with Dr. Ferroli over at J.P. Morgan about the two parts of the American economy, the domestic part and export-import, even the inventory build that's being discussed. That trade balance number today was a wow statistic. How apart is this economy that Chairman Powell faces, domestic and trade?
Well, a lot of it is trade because of the backups that we've had, Tom. All those ships off the coast that were holding goods and couldn't land in December, in January, have finally started to come ashore. We're getting all of those imports. Plus, the economy here is strong, and people have been buying, and we buy a lot of things from overseas. The general feeling at the Fed is that those numbers are going to start to correct. We'll start to see the trade balance fall. But it is bad news in the short run, and they acknowledge that the economy has been weak in the first quarter.
Meanwhile, the FOMC did repeat their comment that with appropriate firming in the stance of monetary policy, the committee expects inflation to return to its 2% objective and the labor market to remain strong. Objectives that some people would say are at odds with one another at a time where it's very hard to see another way for inflation to slow without dampening demand. What kinds of changes are you expecting to hear around the edges to one or the other in order to understand the prioritization of the Fed right now between inflation and their labor market mandate?
Well, it's going to be interesting to see if the chairman, at least, has changed his view, or if he speaks for the committee in changing their view of where they think inflation is going to be, particularly by the end of this year, if they are going to be more aggressive in raising rates. We don't get official forecasts this time. So do they raise their estimate to match what the market sort of sees happening? The other aspect of it is when you go to economics school, they teach you if you're making a forecast, give a number or a time frame, but don't give both. growth. So yes, they expect inflation to go back to 2%, but they're not saying by when. The answer on the unemployment side is the Fed has been very confident that with 11.5 million jobs out there, they don't have a big risk of sending unemployment up a lot in the short run. Over a longer term, perhaps, but right now, they feel if you lose your job, you can probably get another one.